Chairman Barr, Ranking Member Foster, and subcommittee members, thank you for the opportunity to testify today. My name is Francisco Covas, Head of Research at the Bank Policy Institute. We are a research and advocacy group supported by banks with over 100 billion in assets. Our membership spans the full range of banks under the Federal Reserve stress tests, so we are keen to testify today. The stress testing regime that underpins the capital framework for large banks consistently demonstrate that US banks are well capitalized and can continue to support the economy during economic downturns. Since 2020, stress test results have been used to set a stress capital charge, effectively part of large banks' minimum capital requirements. We support using a stress capital buffer in overall capital requirements. However, the lack of transparency in the Federal Reserve stress testing regime has significant economic costs that can adversely affect US financial system and the broader economy. The opacity and inaccuracy of the Fed's models create uncertainty for banks about the level of capital they are required to hold, leading to excess uncertainty buffers that reduce credit availability and decrease market liquidity. In my written testimony, I provide several examples that highlight the inaccuracies and the volatility inherent in the supervisory stress testing models used to determine the stress capital buffer. Year after year, we observe significant fluctuations in the stress capital buffer that often fail to reflect actual changes in banks' risk profiles. This disconnect can be attributed to various factors. First, the lack of granularity in the Fed's revenue projections, which are prone to inaccuracies and volatility. Second, the Fed's models consistently underestimate trading revenues during times of higher market volatility, a finding that runs counter to historical experience. Third, operational risk loss models have proven to be inaccurate, with projected losses increasing in the post-pandemic period despite the absence of a corresponding rise in real-world losses. Fourth, loan loss models also tend to overestimate losses compared to banks' internal projections, likely due to the Fed's inability to properly account for bank-specific factors. Fifth, compounding these issues is a flawed reconsideration process for appealing stress test results, which suffers from a lack of independence and transparency. It is also important to have notice and comment on the scenarios used to calculate the stress capital buffer. Our analysis reveals that the 2024 stress scenarios diverge significantly from historical experience and the Fed's own guidance. Several macroeconomic variables in these scenarios are dramatically more severe than those observed in previous US recessions. Consider this example. In just the first quarter of the stress planning period, the severely adverse scenario in this year's stress tests assumes a decline in the house price index exceeding 15%, and this is not annualized. This projection far exceeds what we observed during the 2007-09 global financial crisis. Such an extreme scenario implies unprecedented shifts in other macroeconomic variables, including sharper initial increases in unemployment rate and steeper declines in short-term rates. The result? Financial institutions face considerably higher projected losses and lower revenues compared to prior severe recessions. Moreover, the calibration of the global market shock component that applies to the largest banks has become less transparent over time, so it isn't clear what scenario the GMS currently represents. In summary, increased transparency in the Fed's stress testing regime is necessary to reduce uncertainty and promote a more efficient financial system. US banks are very well capitalized, but the current stress capital buffer framework suffers from excessive volatility, inaccurate projections, and a flawed reconsideration process, leading to less lending and increased market liquidity. Moreover, the stress scenarios violate the Fed's own guidance and are significantly more severe than historical recessions. Allowing public comment on scenarios and supervisory models would enable extensive review by experts, academics, and banks. This would increase transparency in scenario design and improve model accuracy, fostering a more effective financial system that better serves the US economy's needs. Thank you again for the opportunity to testify. I look forward to your questions.